Today, I want to talk about the new ruling that demands that shorts must disclose their true short positions, and how a member of the SEC just said that another meme stock rally will happen. So stay tuned and let's make some money. And now I'll dive straight in with the key information. So, Gavin tweeted saying, breaking news, hedge funds will now be forced to reveal the names of the stocks that they are shorting, saying that hedge funds will be forced to reveal short positions in certain stocks at the end of every month. And that's not just for regular short positions, it also includes derivatives and swaps. So if they're using either total return swaps to roll FTDs and roll short positions, those have to be disclosed too. Or again, if they're also using married and divorced puts to hide their FTDs and reset the counters, those also need disclosing. He said the SEC would aggregate all of that data for all of the hedge funds before publishing the final results. So these hedge funds and these shorts will have to disclose all of the stocks they're shorting and how many shares are being shorted by each fund. Gavin also clarified, saying swaps, derivatives and everything else all need to be reported at the end of every single month directly to the SEC. Gary Gensler said in the wake of the 2008 financial crisis, Congress directed the SEC to enhance the transparency of short selling of equity securities. He said today's adoption will promote greater transparency about short selling both to regulators and to the public. And he said given past market events, it's important for the Commission and the public to know more about short sale activity in the equity markets, especially in times of stress or volatility. Specifically, Rule 13F-2 will require institutional investment managers that meet or exceed certain thresholds to report on a new Form SHO specified short position data and short sale activity data for equity securities. And there's also a second amendment or new ruling that says the amendment to the NMS plan governing the CAT will require each CAT reporting firm that is reporting short sales to indicate when it is asserting use of the bona fide market making exemption of Rule 203B. So the market makers and these hedge funds have to differentiate which is a normal short sale and which is a short sale under the market making exemption. aka, I guess more specifically, which is a normal short sale and which is a naked short sale. So these short sellers now have to disclose all of their short positions, the regular shorts and the naked shorts, I guess both be it legal naked shorts or illegal naked shorts. And this ruling is being introduced and implemented 60 days after publication of the adopting release in the Federal Register. So I guess it becomes effective 60 days from today. Now I also wanted to go over this open commission meeting from the SEC where a member of the SEC just said in the future event of another meme stock rally. Corey added saying they just said another meme stock event is likely to happen in the future. All of you are hedging for a collapse by holding AMC stock, but many out there also love to buy and hold rare and precious metals. Some metals like gold and silver are really easy to get your hands on, but other rare metals like lithium, nickel and cobalt are much harder to obtain, and are even more precious when used during EV construction. EVM Assets allows you to buy these metals using US dollars, via either Apple Pay, credit or debit card, or even bank transfer. And the best part, EVM Assets will even hold and warehouse your metals and also process sale orders when instructed by you. EVM Assets also have no minimum purchase requirements, so it's available to everyone. You don't have to spend thousands to meet some kind of threshold. So if you're interested in hedging the crash with precious metals, check out EVM Assets in the description below today.
In reported short positions, which would allow the Commission to observe how large short sellers respond to heightened volatility. Specifically, the Commission would be able to observe on which days reporting short sellers most actively increase or decrease their short positions with more precision, and then correlate this activity to market conditions on those days. This could help the Commission reconstruct market events and design responses to events that take place during times of volatility, similar to the meme stock episode that might happen in the future. Second, the rule would provide aggregated short sale related data in a readily accessible location that is free and accessible to all investors and other market participants.
So just there she said the SEC thinks this is a good thing because the SEC will know on which days these hedge funds and short sellers increase their short positions, and then how those increases in short positions correlated to market activity or market volatility. And that'll allow the SEC to reconstruct exactly what happened or will happen for any future meme stock rally. And as a result, then draft up or plan any kind of appropriate response. Now, I actually agree with all of the above. It will give the SEC more transparency into the market to see which hedge funds are acting irresponsibly and taking out giant illegal short positions. And then they can create a plan of exactly what to do with those hedge funds, especially when they do take on those illegal shorts. And just a quick one, if you didn't already guess, both Hester Peirce and this Mark guy voted against these new regulations. But Hester and Mark were outvoted by the other 3 members of the SEC here, who obviously voted for. So with those 2 members of the SEC voting against these new regulations, clearly the shorts are in big trouble, and they know it. When Mark voted no, he said that short sellers would be in danger of short squeezes, and that short sellers could be targeted due to information being released. Which is pretty much exactly what all of retail investors or all of the retail investing base wants to happen. Which I think really is a good thing for the market because it will mean one less illegally acting hedge fund in the wider space. And on top of that, the SEC is also shining a light on short selling with a new stock loan disclosure. Now, securities lenders would be forced to report share lending deals within 15 minutes. That again will also allow the SEC to figure out exactly who is short selling which stock and exactly how much they're short selling, because they'll be updated with new short sale loans every 15 minutes. It won't just be one report at the end of the month where these short sellers could try and hide their positions. It will happen every 15 minutes. Saying short sellers and other market participants will have to quickly disclose deals to borrow securities under rules expected to be adopted by the US financial watchdogs. Saying obviously investors, typically hedge funds, wagering that securities will fall in value, known as short selling, need to borrow stocks and bonds to make the bets before returning them to their owners. Or should theoretically borrow those stocks and locate them instead of shorting without locating. I think this ruling is also going through at the same kind of time as the other ones, but I think we need to wait for a little bit more information about this specific ruling. Now, I personally think these new rules are brilliant for overall market transparency. Dave Lauer did say specifically he expected a little bit more in these rulings, but said overall they're very good. Although Colin did appropriately say breaking news, hedge funds will now have a new rule they can completely ignore and pay petty fines if caught, all while taking in billions. While these new rules demand these short sellers appropriately disclose all of their short positions, including derivatives and swaps, who knows whether they will actually disclose appropriately. And if they are caught, will they just pay petty fines while stealing billions? I guess this is definitely something of concern. I guess we just need to see how the reporting goes and exactly what that reporting uncovers. And very interestingly, a new article has been released saying Do Kwon from TFL now blames Citadel Securities for Terra collapse. You may remember last year, UST and Terra Luna collapsed in a very short space of time. And it was rumoured that Citadel Securities was behind that collapse, but Do Kwon thinks this is actually a certainty. This article says Terraform Labs takes legal action against Citadel Securities, claiming a potential link to the UST peg, and requests documents from Citadel to investigate the matter. It says Terraform Labs has filed a motion requesting Citadel Securities to provide critical data in response to a third-party subpoena, which they argue is essential for their defence in the lawsuit brought by the US SEC. The motion compels Citadel Securities and Citadel Enterprise Americas, which focuses on acquiring trading data related to the May 2022 DPEG. Terraform claims to have evidence that Citadel Securities was behind the attack, as well as a mound of publicly available information. Citadel did previously refute those speculations, but now they're going to have to produce the documents in court. I personally am very interested to see exactly what Citadel produces and if they were indeed behind the attack on UST and Luna. It seems things are just getting worse for Ken Griffin and Citadel Securities, with lawsuit after lawsuit after lawsuit. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.